All right, I think all day long we're going to talk about whether this was a hawkish cut, was it a neutral cut, was it a dovish cut? What was your take? I felt like Jake Powell's comments about the path forward not really being clear, that was a bit hawkish, but at the same time, the bond buying on the short end, that seems a bit dovish. It seems like it has almost the same effect as a rate cut. How did you view it?
Well, our economists think that it was, of course, less hawkish than the market has priced in. That has been our view all along. But what is important, the biggest takeaways for the equity markets, is that we've got a confirmation of pretty constructive backdrop for the equity investing into the next year, right? So they told us they are going to cut for now. They told us the inflation is pretty much in control. And growth is resilient. What's more not to like, right?
I mean, I think that's what the street wanted to hear. So with that in mind, what sectors are you looking at for the next, 3 months, 6 months, the near to the short term as being the biggest beneficiaries of this cut, with also the guidance from this Fed in mind? Even though we know there might be leadership changes, there might be other composition changes to the Fed, the fact that they only see one cut next year and one in 2027, what looks good right now?
So for us, when Fed cuts into a soft landing or perhaps even no landing, this is the perfect environment for broader set of equities to do well. So in terms of regions globally, historically, in this type of environment, you wouldn't lose money on any region, but there is a tilt for more cyclical markets to do a little bit better. So this is how we are positioned. So in Europe, we've just put out our European outlook for the next year, cyclical tilt, but also really encouraged by the easing cycle of the Fed, resilience in global economy, but even more encouraged by the fact that European economy is being more resilient, and we are going to start seeing fiscal easing into the next year and monetary easing effects from the ECB easing that has already started, right? So pro-cyclical, our top sectors in Europe continue to be banks, but in terms of, so that's more domestic story, but in terms of cyclicality and broadening of AI, the secular stories, it's industrials and it's basic resources. We've actually downgraded tech to neutral in Europe.
Yeah, a lot of other people seeing some issues with tech, whether it's valuations or believing that the growth's already happened. But I want to go back to my question. I want to be clear. Are you saying that Europe looks more attractive than the U.S.? Because you just told me it's kind of a Goldilocks situation, more growth, inflation under control. Is the U.S. more attractive than Europe, or emerging markets more attractive than the U.S.? Where do you see the rankings of regions right now after this Fed rate cut?
So for us, valuations are a limit. Everything is expensive, but the US is particularly expensive. So from global investors' perspective, we can justify buying AI in the US, but for everything else, we argue you should be buying outside because you can buy similar style companies with similar growth prospects, but actually at cheaper valuations. So the US is a neutral for us, even though we are bullish and overweight tech and AI in the US. For the broadening of AI story and a mix of cyclicality as well, we are overweight emerging markets, and Europe, continental Europe, for us is the best cyclical diversifier, where actually a lot of fiscal stimulus is going to start making its way.
Okay, you like the AI trade here in the U.S. What do you make of that Oracle report? Obviously, Oracle is a big weight on the futures this morning. Shares pulling back double digits. Were you encouraged by what you heard from the company, the fact that they're looking at chip neutrality? Is that a tailwind for the broader AI trade, and also the fact that their RPO grew? Or do you also have questions about the funding? And does this report, does it just add to those questions about the funding? Because they didn't really clarify.
So I'm not going to comment on individual stocks, but what has happened, it's in line with our view that we could see going for, it's an evolving story, AI, it's broadening, and there are going to be setbacks along the way, right? So AI as a theme is not going away for us, but given the level of the valuations, our view is that stocks become more sensitive to the news flow going forward.